Earnings season is upon us. Some of the financials are already reporting. We're going to talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we take a look at the markets and some of the upcoming earnings and take your questions. So before we get to that, President Trump is exploring possible temporary exemptions to tariffs on imported vehicles and parts to give those companies more time to set up U.S. manufacturing facilities. And he also said he's anticipating rolling out tariffs on pharmaceutical imports in the, quote, not too distant future. One of the things I wanted to explore before we get to some of these earnings, and I was reminded of this over the weekend, those of you who have watched the live stream for a while may remember, I think it was back in September or so of last year, that I had mentioned that there were some stocks where I thought the valuations had begun to get kind of interesting and compelling. One of the contexts for that was with respect to nuclear power. And so there were some people who were investing in nuclear companies. I think it may have been prompted actually about a question on NuScale Energy, the small modular reactor company. And I had pointed out at the time that I thought maybe a better way to play it would be to get long Fluor Corporation. Fluor is the EPC company, that's engineering, procurement, and construction. So they have an investment in SMR, but of course they have a very mature and successful business otherwise. Now, when we talked about it in September, that stock actually did rally considerably. I think it was up from the time that we talked about it through the election by about 30% in total return terms, maybe just under, something like 29%, if my memory serves me correctly. Along with many other stocks, though, that thing has fallen back quite sharply in the time since. So I wanted to just talk a little bit about how I think about circumstances like this for people who are long-term investors. And I wanted to just talk about Fluor Corp first. So we're looking here at a business, and I'm sharing my screen. Hopefully we have a mechanism to do that. So I'm just going to, I forgot to get that set up before. So I just want to make sure I have it working. There it is. Good. It's on. Let me see if I can blow this up a little bit so it's a little more legible. Okay. So, as many will know, when it comes to single stock picking for me, and certainly when we're going to be talking about it here, I'm generally speaking about long-term investments. I think it's totally fine for those that don't want to pick stocks, that they buy a proxy for the broad market like a SPY or IVV or VOO. Nothing wrong with that. Very low fees, historically very good performance. Of course, some of us can't help but also pick around and see whether we can't find companies that we think are attractive. And for me, the things that make it attractive is, number one, is the company growing at least as fast or faster than the economy? So when I say, is it growing, I'm talking about the top line. I'm talking about sales growth, revenue growth. So that's the first thing. Fluor Corp certainly qualifies. So if we just assume that the economy is growing nominally at 3-4%, so that's inclusive of inflation. So that would suggest that 2 to 3% inflation plus maybe 1% GDP growth real, this company would certainly qualify. And it has given back all of the gains that it made between September and November since that time, and then some. So if I thought the company was reasonably valued beforehand, I certainly would think that it's reasonably valued right now. So full year EPS estimates are for about $2.50 a share. It's priced at $33.61 right now. Let's just round it up. We'll call it $34, and we'll round down the EPS number, and that gets us, we'll say $2.50 a share. So if it's $34 at $2.50, that means it's trading at less than 14 times, 13.6 times full year estimated earnings. Also very interesting. Take a look at the enterprise value. $3.8 billion. And that's with a full year estimated free cash flow of about 400. So I'm going to round this down and call that 400 million in free cash flow. And I'm going to round this up. Let's just round it up to $4 billion in enterprise value, and that gets you free cash flow to enterprise value of about 10%. Now, this isn't, we don't on this live stream just talk about picking stocks. We're also interested in trying to see whether option strategies might make an interesting opportunity. And here, while the stock is down, implied volatility is up. And it's up quite a lot, as you can see here. So this sets up, interestingly, in my mind, for if anybody uses something like a wheel strategy. So a wheel strategy is when you own a stock and you sell covered calls against it. And then if you get called out of the stock, you can sell cash covered puts against it. Now, I wanted to make one quick point simply because tomorrow is tax day, and I was just reminded of this as I thought about the wheel strategy, that one of the downsides of a wheel strategy, so you buy the stock and you sell covered calls, if you let yourself get called out of it, you can start incurring various taxable events. I'm not giving tax advice. It's just something to think about. If it's a tax-deferred account, this won't apply to you. Do your own work. But sometimes it can make sense to simply cover, that is to buy back covered calls before they expire and just roll up and out, that kind of thing. But I wanted to show you one way, if you're doing a cash covered put, to get into a position. If you think the stock is undervalued, then you want to give yourself a decent amount of upside. Now, with these kinds of implied volatilities, what you're going to find is that the standstill rate of return on overwriting strategies is quite high. So that means that the premium you're going to collect is going to give you a very handsome rate of return. Now, you are going to be selling away some upside if you do that. Obviously, in a technical sense, this is not overwhelmingly positive, but from my perspective, one of the things I do when I'm looking at fundamental pictures, obviously I will take a look at the technicals, but not everything's going to line up every time. If you feel like you're getting a good company at a good price, sometimes that's really the thing to think about first. So let's just take a quick look, and I'm going to come up with two different strategies here, or why don't we'll use three actually. So let's first assume that you buy the stock and then you sell a call. Because implied volatility is high, perhaps you want to sell a call that is a little bit further out in time than you normally might. But for now, we'll just use 30 days for the sake of argument, or let's see, what's the next expiration beyond that? So yeah, so 30 days. We'll start with this because it doesn't have weeklies. And if you bought the stock right now, 33.5, sell the 35s, you can collect about $2 for those. So I usually like to look at the premium two ways, relative to the strike and relative to the stock. So if we just round this up, well, we'll call it 33.61, 33.60. So you're collecting about 6% in premium for those May 35 calls. So if you bought the stock here, 33.60, sold those calls for about $2, you're collecting about 6% on a standstill basis over the course of 1 month. Plus, you still have another $1.40 worth of potential capital appreciation over the current stock price. So that's going to be another 4%. So you have, 10% potential upside. If you wanted to get into the position partially, maybe you would do that because you weren't so enamored of the technicals. And you said, well, I'm kind of more interested in this downside support. So if the stock has support at 29.20, maybe I'd be willing to sell a put just above that level. So that would be the 30 strike option. So we can take a look at those. And you can collect about $1 a share for those. So if you wanted to do it on a partial, let's say you were going to buy 200 shares, you buy 100 only. Buy 100 shares at 33.61, spend $3,360, collect 200 for those upside calls against what you already purchased, and then sell a downside put where you might be interested in collecting a little bit more money, collecting a little bit more premium, or potentially adding to the stock at about a 10% discount to its current price. This is something that you could consider. Now, you may also be wondering, well, how do you even go about trying to find opportunities in a situation like this? And for that, now I don't know what kind of screening tools you all might have available. I happen to be using a fairly simple one that the Bloomberg terminal happens to offer. And really, what I'm most interested in is what companies have been particularly hard hit that are not trading at exorbitant valuations, so giving myself a little bit of a margin of safety, and still exhibit that top-line growth perspective. So I'm not focusing so much on earnings. I'm focusing, in this case, and you can see that this is a universe of 3,000 stocks. This is the Russell 3000 index I'm looking here. My refined universe, which doesn't happen to include Fluor, I don't think it does in this particular filter. Let me see. I don't think that showed up in there. It did not. And there's going to be names in here, for example, that are you need to do a little bit of scrutiny each time. So, for example, when I was doing this over the weekend, one of the things that was popping up was Edison. For those that EIX. So, for those who don't know, utility company, I think utilities may provide an interesting opportunity. Some of them were particularly hard hit, especially the growth-oriented ones like the Vistras of the world. But Edison, of course, and this is the reason why when you do this kind of a filtering technique, you want to then go and start doing a little bit more homework, check the news. Edison reported recently that they are increasingly thinking that a decommissioned power line was re-energized and may have caused the Eaton fire. So I don't think I need to explain to anybody that that's obviously a massive liability. And so you are going to find that if the first step you have is simply to say, I'm going to look at stocks that have plummeted and whose valuations look compelling on a trailing basis, that you still need to double check the news because names like that are going to pop in. And actually, that reminds me, somebody was asking me last week about Pfizer, which was trading very poorly. And I was mentioning that the fundamentals didn't look that bad. Since that time, we have had news on Pfizer. So in Pfizer's case, they've decided that they're not going to proceed with their obesity drug because one of the people in the study was showing signs of liver injury. That's obviously a big disaster. So that probably helps explain one of the reasons why there was such significant weakness in Pfizer. Were people trading ahead of that already knew it? I have no idea, or did they suspect? I'm just making the point that sometimes things are trading lower for a reason. But yes, so in the case of Fluor, interesting kind of a situation there, something worth exploring. Also, we got earnings out of Goldman Sachs. Now, I was on Fast Money last week. One of the things I commented about when I was asked about the financials was that I had said that the investment banks, meaning Goldman Sachs and JP Morgan, and I think I was highlighting JP Morgan at the time more than Goldman. I have to go back and watch the tape, as it were. We're very likely going to see better results from their trading units than had been baked into the cake, because there's little chance that anybody who is looking and forecasting the most recent quarters for these businesses was going to expect the kind of volumes and volatility that we saw earlier this year. And the interesting thing to think about for the investment banks when it comes to trading, and I made a distinction, I should say, between Morgan Stanley, which has increasingly focused on asset management in recent years, versus Goldman and JP Morgan, which still have as a share of their overall business, more in the trading side, that it isn't just about volumes when things get really choppy. So when things get really choppy, these companies can do better, in part because they will see larger profits on some of their trading. And the reason for this is that not all of their business is strict commission business. The fixed income business is a balance sheet, capital commitment, dealer-focused business, and the spreads you get are wider. So you're trading more and you're making more each time you trade. Put those two things together, you get very nice results. That's what happened in this case of Goldman, and I am sure that's probably going to be true for other companies that are engaged in the same space that have yet to report. So we do have that. Okay, so let's get to some questions. Steve Garcia says, I own ETFs and stocks, some with 100 plus shares, some less. How do I collar my whole portfolio's value, not each stock? Short calls are tricky since I may lack the shares and they only cover single stocks. Yes, excellent question. So the first thing I would say, Steve, is do you have a customer portfolio margin account? Because if you have a customer portfolio margin account, then you will receive some cross-margining benefit if you have a portfolio of stocks and then you use, for example, options on SPY, right? So I get a cross-margining benefit if I trade SPX options, and I also have positions in individual single stocks. So for example, if I'm short SPX vol, long vol in a number of single stocks, I'm going to see a cross-margining benefit from that. So what you want to do then is try to come up with the best possible proxy. Sorry, I had pulled up this is just a model that I had pulled up for Goldman Sachs. I was looking at this earlier. This is not, so don't focus on that. Let me bring back here. This is what I wanted to bring back. There we go. So for example, if you have, say, $500,000 in your portfolio, then that's equivalent in, round numbers. We're going to say that that's going to be a little more than 1,000 shares of SPY, right? So you could use that as your proxy. And if you have a CPM account, you should probably get some cross-margining benefit, and you should be able to trade that. This is also, by the way, much more attractive than, I don't like the idea of taking naked short call exposure in single stocks or even narrow industries, because you end up being subject to things like idiosyncratic risk. So for example, if I own 50 shares of JP Morgan, let's come up with an example. JP Morgan's, it pops into my head, and there's a story behind why it pops into my head, and I'll get to that. It actually isn't really that applicable to JP Morgan at this time, but I'm using it as an example because there's a real story behind it. So all right, so I've been told that my screen share is lagging just a little, so I'm not going to move my cursor around too much as I speak. Let's imagine that rather than owning 100 shares of JP Morgan, you had 50 shares of JP Morgan. So, we'll call it, instead of having $23,500 worth, you got $12,000 worth of the stock, round numbers. And you might be interested in selling an upside call and buying a downside put to give yourself some measure of insurance. Well, the problem that we have is that each call represents 100 shares, and you're only long 50. And I'm going to show you what this P&L will look like if it's uncovered. I can't really use subcontract units, but I'm going to show you what it would look like. So I'm just going to modify this one and say, okay, so we're actually, can I do that? Let's see. Can I put the 50 in here? Yes. And we're going to add a call, and we're going to add a put, and I am short the call, I am long the put. Let's put some mid-market prices in here. And it does not seem to, so it's basically just taking my delta down. What you're doing is effectively, I can do this a bit differently. I'm going to do it like this instead. So we are going to say we are long 100 shares of the stock. We are instead going to say that we are short 2 of the call, upside calls. If you do just one, by the way, notice that what you get a short straddle, right? So, and the reason for that is a short call plus a long stock position is, short. Yeah. So short call long stock, you're effectively short a put. So if I am short 2 calls, but only long 100 shares, then I'm short 1 call naked, and then I'm short 1 synthetic put. That's how you come up with the short straddle. All right, so then we're going to buy a put to protect it. And again, it's going to be twice as many. And now I have to spread these out because you would probably be doing this in such a way that, let's see, let's assume that you were doing a 250 call. And we're going to pick a downside put here. Yeah, you're going to end up with a very funky looking situation like this, which is what Steve is talking about. So instead, if you happen to have something that looks more like S&P exposure in the aggregate, you would ditch doing strategies on the individual issues that you hold where you don't have a sufficient quantity of the underlying, and instead just trade the SPY structure, okay? So that would just mean that you figure out what the aggregate of your portfolio is and put that collar on that. So if it's $500,000, maybe we just do a 10 lot. The delays, so both my screen actually is delayed as well as yours for what it's worth, but okay. The other thing is, you know, if you're concerned about selling naked upside, which is a legitimate concern given the big spike we saw a week ago, I happen to think we might start bumping our heads a little bit. We get up to this 5,600 area. I have a feeling we're probably going to be running into a little bit of trouble up there. At least that's what I think was identified as a level by my friend and colleague Carter Worth. But then you would just put on a SPY trade. So selling an upside call, buying a downside put or put spread. Let me put it like this. You're going to get this naked short upside, but it's not really naked because, of course, you have a whole basket of stocks underpinning it. And assuming that they behave generally the way the S&P does. Now, I'm going to sell an upside call, not an at-the-money one. So maybe I would say sell the 565s, and you get something that looks a little bit more like this. And maybe I don't think it's going to get back down to that 485 level. I'm more concerned about this immediate downside here. So I could trade something like this at very little cost. And that would be a way to protect the whole portfolio. And that's a good way to think about it. In fact, I mean, really, this is even what dispersion traders are doing to a degree. You know, you're getting long vol in individual stocks and you're selling volatility in the index, right? So, but to do that, you are going to need CPM, I think. I don't have a conventional Reg T margin account, but I'm pretty sure that that's not going to work quite the same way. So there is that. Okay, so Netflix is reporting on Thursday, and they are pretty much tariff-proof. Yes, indeed. Let's take a look at what you have here. I'm going to put this in. I have, you know, I've referred to Netflix as kind of an unregulated utility because I feel that it's very hard to imagine folks severing their Netflix subscriptions. I kind of feel like it's going to be one of the last things to go. And you know, in that sense, I think it is a pretty safe business, very attractive for that reason. So let's take a look at the structure you have here. Long one, April 9:35, and it looks like you actually have the April 25th 9:35 call. Short 1,000. I'm assuming that's also the April 25th 1,000 because I don't see an expiration associated with it, so we're just going to stick it in that way. Let's see what this looks like. So this is a call. So now we're in that. So long one. So the 9:35 1,000, April 25th. And then, oh, this is interesting. And then the April 17th, you are short the 985 calls. And then you're long the 1025s. So you're long one call spread and short another. I'm going to like this. Let's just make sure I have this right. Long the April 25th weekly 935 1000. Okay. And short the April 17th 985 1025. So you're long a longer dated $65 call spread, and you're short a shorter dated $40 call spread. And we end up with something like this. And I'm assuming that the exercise here is to try to get a little bit of decay against the longer spread. So we've got Netflix is going to be reporting on the 17th. So you're short the earnings week. Now let's just take a quick peek here so we all can look at it. Bring up unusual whales, and let's just take a look at how those April 17th options are priced relative to the history. I'll just bump down here to earnings, throw in Netflix, and here we are. So this is a 12-quarter history. You can see that the implied move is 8.4%, and as it might be hard for you to make it out on the screen, I'm going to try to bump this up a little bit so we get a bigger picture. Okay, so we're looking over here. You can see that this is actually the largest implied move for Netflix, going all the way back to here. And then, by the way, this is kind of a cool feature also. If you happen to be using unusual whales, you can actually hover over each of the prior quarters, and you can see what the implied move, which they describe as the expected move, was for each of those quarters, and combine that with what actually happened. You're going to observe something here, which I think is well worth paying attention to, is that this is a company that seems to have quite a history. You know, it typically implies a pretty good sized move, but more often than not, in the last 11 reported quarters, it actually has moved even more than the market expected. So let's just take this last quarter, for example. The anticipated move was plus or minus 7%, round numbers. The actual move was 9.7. Let's round it up to 10. Why do I want to round it up to 10? Because I just want to keep the math easy and think about this position that you have. So you are short the 985, these 985 calls, right? So if this thing were to have a 10% move, if it happens to do the same thing again this week, when they report, that's going to take us up to 1030-ish almost in Netflix, right? So it is worth noting. Now, I will say this: if you're going to short premium going into an event like earnings, I'd much rather see you do it in the form of verticals. Define your risk. I think that makes more sense. And you are hedged because you own this longer dated call spread. So that is going to appreciate in that case, right? But you are going to start giving away some of this upside up around $1,000, which that's not completely out of the frame, right? So, I might consider. Here's the thing that I really, it's an important point, I think, that I would like to make, which is there is nothing more frustrating in trading than having the correct thesis but the wrong position. So if you're bullish on Netflix and they report and the stock's up 10% and you don't make money, how are you going to feel then? Not great, right? So if we're going to take risk that, where you lose money if your thesis is wrong, not if your thesis is right. Is it going to go up 10%? I have no idea what the stock's going to do after earnings, but what I have illustrated, and what unusual whales data reveals to us, is that it is very common for this stock to move quite sharply. I mean, look at this. We have, we're going back now 10 quarters, so this was up 13%, up 8.5%, so that wouldn't, that's going to be testing you, to be sure. This one, that shorter dated short call spread would go right to max value and then some. Q4 2023 up 10.7, same thing. And then actually the last two most recently reported quarters, up 9.7 and up 11%. And the stock is down right now, which, that makes it vulnerable, a little more vulnerable anyway. So what do we got? The street's looking for $25-ish for the full year. And for this quarter, we're expecting, what are we looking at? Estimates for about 570. All right, so let's just think about valuations here. If they manage to stay on track, we are trading, I'm going to just use round numbers, as I often like to do. We'll just call it 950 and 25. So 38 times at a 27% annualized growth rate. And how are we doing on free cash flow yield? 8.5. So better than 2% free cash flow. Yeah, I would just give some thought to that, right? Maybe you could sell a downside put spread perhaps instead of that. I'm assuming your thesis is that you're positive based on your remarks. So I do like the fact that you're trying to find some offsets, but sometimes we can get a little bit cute and you end up in these kinds of situations. You'll still do okay because you got that. The spread that you own is wider than the one that you were short. But the only issue I have with the one you're short is that it lands somewhat unhappily right within that expected move. And if it is positive, that's just going to go to its max value. And then that trade-off isn't going to seem like such a great one. Okay, so Eric M., I hold some GLD and GDX. Saw that Goldman forecast 3,700 price target for gold. What's your thoughts on best option strategies for further upside call spread risk reversals? I like call spread risk reversals because I think the hazard of a meaningful downside move is muted, and we are seeing higher implied volatility in general. I will say that end of last week, I was thinking about a relative weakness in some other areas of the precious metals complex on a relative basis compared to gold. And why I like you having exposure to the miners is that they will benefit if some of those others play catch up. So, for example, the silver to gold ratio, a little bit light. Platinum, obviously, hasn't quite kept pace. So, yeah, I mean, you don't sell your winners. You compare your winners to rebalance, as I've mentioned a little bit. I will also say it's kind of funny. Goldman is saying they're saying 3,700. I read over the weekend that they had said that 4,500 by year end isn't out of the frame, which is pretty remarkable and also very scary. And I also thought, sell gold on the news, simply because by the time they're coming out publicly and saying, okay, gold could go to 4,500, I kind of feel like it's going to start running out of gas soon. There are certain things that I kind of feel like it's it's like the commentator's curse, in golf, when you hear the commentator say he hasn't missed a putt inside of 3 feet, the whole tournament. And then you can pretty much rest assured that, the yips are going to jump in right then and there. So other than the fact that when every single last person comes out and says, gold's going to go to the moon, that's probably when it's going to run into a little bit of resistance. And there's you could argue that there's a reason for this. If every single person is looking up, then the risk is actually going to be to the downside. But I do think that if you're long it, as I've said, the rising acronym that I had for the live stream at the beginning, RISIN with 2 G's, because the other G in my rising acronym was Google. That hasn't turned out so hot. Obviously, think it's a great diversifying asset to have in your portfolio. And GDX, I do like that because, like I said, it's got exposure to some of these other areas. So let's have a quick look at how you could use a risk reversal in GDX. It sounds like you already have a position, but for those who do not, GDX is the ETF that tracks the minors. There's also GDXJ, which tracks the junior minors. But we'll just stick with this one for now. Remaining bullish, but deciding that you want to protect yourself against a little bit of downside, look for some potential areas of support, sell a downside put. I think you can probably go out. This one's going to have weeklies, so maybe we go out 45 days or so. You could essentially be long. If you wanted, you could do this like a poor man's covered call with this, with this strangle component against it. Buy something a little bit longer dated if you chose to do that. That would certainly be fine. So what are we talking about if we did that? That would just be, buying something that's further out in time and then selling. So we want this to be pretty close to at the money. So I'm just going to choose a 50. And then selling, 6-7 week 20 delta strangles, for example. You could do something like that against it. So we could pick, let's say, what we got here? Pick the 59 calls on the upside. On the downside, we could maybe look at something like these, 44 halves or the 44s. We're going to sell both of those, and you're going to get something that looks a little bit like that. So there will be a mild standstill rate of return. The real risk is going to happen if you end up having it blow through that downside strike, which in this example, I believe I picked the 44 and a halves. That's going to be more than a 10% discount to where we are right now, though, right? So, if you're just taking a look at this, you can see, that's not a terrible place to draw a line in the sand, because there apparently is some support at 44. So, yeah, like the strategy, like the space, that's a way you could potentially play it. Okay. James Forbin is sort of following up on that Netflix conversation we were just having. So like I said, it's implying a move of about 10%. It has been realizing moves of about 10%. So, you can do credit spreads if you want to try to make a play. But what I'm going to say is that options aren't grossly overpriced for making a move. One thing you could think about doing if you really wanted to define your risk, probably people don't think about this too often, but something you certainly can consider is actually trading it in the money call spread or put spread. If you trade in the money, so here's the, you might ask yourself, well, why would I choose one versus the other? Really what this is going to come down to is that if the stock moves in your chosen direction, does it increase the likelihood that you're going to have some complexity to contend with in and around expiration? Because, we are dealing with something that happens this week. Would you rather be short a spread where both options are out of the money, or long a spread where both options are in the money, and contending with whether or not you're actually going to get assigned on the short leg of your call spread? This is assuming the stock goes up. Whereas if you're in the put spread, you could just end up being put the stock if it's through the short strike, which is going to be the higher strike. Because if you are in a bull call spread or a bull put spread, in both cases, you're going to be long the lower strike and short the higher one, right? So I don't know if that makes some intuitive sense to you, but that's the gist of it. Let's come up with an example of each of these. So I'm going to do first let's default it to call, so why don't we start there? And I'm just going to do one that expires at the end of the week. So this is a call. We're going to be short this one. And let's just say that we're looking for, maybe 5% of the move. So that's going to be about 45 bucks. So what are we trying to do here? We want to get down to maybe something like this. And take this up to the Well, let's choose the 980s for the sake of argument. So you get a trade that looks a little bit like that. You can flip this around and do puts, and you can see that it looks basically the exact same way. And the more you reduce this put strike, so if you're selling a put credit spread, for example, to make your bullish bet, the more extrinsic premium is available to you, but the less upside delta is available to you. So that's the trade-off you're making. And, each of these can have their own benefits. The only thing I'm going to just remind everybody of, last thing we're going to do here, is just to say that if we look again, these trades tend to be most attractive when you think that this number, the expected move, is way too high compared to what the stock can deliver. And that's when you're really looking to get those credit spreads on. And I don't know that, is it a higher expected move than it has been in the past? Yes, but it hasn't been high enough in the past. And we're in a pretty choppy market, right? We've seen some pretty big moves. So, things to think about. Okay. For what it's worth, Tom Sosnoff mentioned a couple of weeks ago that he hedges each stock. So in summary, bring your positions up to round lots. Portfolio level hedging isn't enough. Now, that's an interesting perspective, but I would like to offer a counterpoint. And my counterpoint is this. And this is less applicable now because we've just gone through a really choppy period and index volatility has gone up quite a lot. But, if you're doing something like a put spread collar, you're short 2 options, long 1. So you're not really getting long a ton of Vega. But if your portfolio hedge, let's just say for the sake of argument that your portfolio hedge was buying a 30 delta put, would you have been better off buying a 30 delta put in all of the individual stocks that you held ahead of the recent things that have happened over the course of the last couple of months? Or would you have been better off buying a 30 delta put in the S&P? And the answer is you absolutely would have been better off doing the latter. Why? Because when the market really blows up, correlation rises. Implied correlation rises. What does that mean? That means that the extrinsic value of options on the index rise at a faster pace than the increase in the implied volatility of the constituent stocks of that index. That's what that means. So you're going to get better bang for your buck in low volatility environments buying general index hedges to basically protect against a complete washout than buying hedges on all of those individual stocks. First of all, buying hedges against all of those individual stocks is going to cost you more unless implied correlation is one. I don't know if that makes intuitive sense, but the relationship between the price of options on index relative to the implied volatility of the constituent stocks is a function of correlation. We can call that implied correlation if you like. And imagine, let's just come up with a really simple example. Let's imagine you held 10 stocks, okay, on January 1st of this year. You own 10 stocks, and let's say you had $100,000 in each of them, so $1 million portfolio. And let's further imagine that you were concerned about downside. And so what you did was you bought an out-of-the-money put option on each of your 10 stocks. The amount, assuming that we didn't run into the problem that Steve was just talking about, that you didn't have something that didn't pair off really well. So what would be an example of something like that? Priceline, right? Or Booking.com it is now. But still got Priceline in my head from the old days. These are expensive stocks. These are over, you're a 4-figure stock. So you're not going to have a round lot in that, right? So that's probably going to cause problems. That's the first part. The second part is, if a market disaster is really what you're expecting, what if not every one of your 10 stocks got absolutely hammered? Well, if you protected your whole portfolio, you own downside because of those puts. You may have actually made more money on your index hedge than you lost on the stocks you held if you had particularly good stocks. And you can monetize those hedges and deploy a little bit of extra. So, look, I'm not, Tom and the gang at Tacey, they do a lot of work. First of all, he's a very seasoned trader. He actually has been in the business longer than I have. His cherubic face notwithstanding, he probably looks younger than I do, but in fact, he's been at this longer than I have. So I'm not trying to say anything about Bat and Tom and all those guys, smart guys, and they do a lot of research. Right? So they back test their strategies, and I think that's important. But as a guy who traded dispersion, so being short index vol to be long constituent vol, the thing that I generally dreaded was huge market washouts because correlation would shoot up and that would hurt me. So the flip side of it hurting somebody who is in the dispersion trade is that if you are long the index vol, you are a winner in that case. So that's just an important thing to think about. And it's just going to be cheaper. At some point, I think I was seeing that implied correlation. I mean, it was low double digitsly, 15 or lower. So there were points where you could buy some down. Not now. I mean, vol came in a lot today, and but it's so much above average. It's not as easy to buy hedges at this point. But you don't need those hedges to protect you against quite as much because a lot of damage has already been done. So Paul 2.5 floor in Naguna Nagel. Yeah, so previously in Irvine. Yeah, that's more important to me than the location of the business is the success of it, and of course that it's domestic because with all the tariff stuff going on, that's a whole nother thing. It makes it very hard to really get a good grip on what the stuff is going on there. But yeah, worth mentioning. Okay, Michael Anthony, is either one tariff proof, Pfizer or LYFT? So what Pfizer needs is they've got to replace the obesity drug. And one of the things that the current administration has made clear is that they're not that jazzed about pharmaceuticals being manufactured overseas and imported. And, they're talking simultaneously about suspending or delaying or mitigating in other ways tariffs on things like autos and auto parts, which makes a lot of sense because it does take some time to either adjust supply chains, build new factories, make whatever changes you're going to make. This doesn't pivot on a dime. So you need to there's two reasons to do it, but not the least of which is that if you want people to be able to have some kind of capital planning, investment planning, they need to think that they're in a predictable environment. Just suddenly saying, oh, you were operating just fine, but we've just decided to make it so that you can never make another dime again. I mean, you can't live in a world like that. So I appreciate them being a little bit more thoughtful about how something like that might be implemented. I wanted to say one other thing, too, which is that, and I may have mentioned this last week, I've heard there's these memes out there where the Chinese are showing, morbidly obese Americans making shoes. I mean, it's obviously AI generated. They have some where they've got J.D. Vance and Elon Musk and Donald Trump all toiling away in a sneaker factory. And I keep hearing folks say, Americans don't want to make sneakers. Well, I hardly imagine that's anybody's highest potential calling in life. But it is not accurate to say that Americans don't want manufacturing jobs, and it is also not accurate to say that we can't have them. We have built new manufacturing facilities, and we are we make new cars in this country. Mercedes-Benz makes cars in Alabama. BMW makes them in South Carolina. Honda makes them in Ohio. Tesla makes them in Texas. And arguably the least likely place for anybody to build a new car factory, Northern California, not far from where I currently sit. We obviously can do it. And we need to create incentives to do it. And those jobs are better jobs, in most cases, than some of the service jobs. We can't, it's not reasonable to suggest that just because someone doesn't want to make Nikes means that we don't want to have manufacturing plants in this country. That's absurd. And what is the alternative for some folks? You know, one of my sons, he has a part-time job. He was bussing tables at a nearby restaurant. Is that the job that everybody wants to have? Someone's got to do it. It's, you know, not every job is the most desirable one, but better jobs than some, and a bigger, you know, we will automate some of the things. It seems like an absurd thing to me to say, oh, we can't, you know, it's unrealistic to say we can have manufacturing in this country. That's, whoever says that is an idiot. Plain and simple, because we have built new factories and we have built them in almost implausible places. And so that's pretty much all I have to say about that. But obviously I have fairly strong opinions on it. But, you know, I hear this kind of stuff, this chatter being offered, and it really isn't thoughtful. And these are people who do not seem to understand what is actually taking place in the country and what has done. So, all right. Monday morning quarterback for GLD. What portfolio allocation do you like? So frankly, I don't know that it's outrageous to say that between, if you are invested in crypto, I realize not everybody is, but with a 5% allocation to something like gold and silver, or gold, silver, palladium, platinum, or just the miners, would that be outrageous? No. And would you also have some crypto exposure potentially? Well, yes. So I don't think 5% is inappropriate, frankly, for precious metals, particularly once you include the miners in there. So it's a little bit tough to go to 4% now. I mean, simply because it's had such a run. And my normal attitude about this is, let's say you wanted to have a 5% allocation, so you're allocated 5%, and then it starts outperforming, and it may become way overweight, because if you had, let's just assume that everything else in your portfolio behaved like equities did. So 95% of your portfolio is down 15% since the beginning of the year, right? And meanwhile, your precious metal position is up 20%. So even if the rest of it hadn't changed, you would now be at 6%. So you'd have 1% to sell. But in fact, some of these other things have come down even more. So as you're rebalancing your portfolio, you'd actually have to sell a little bit more of your winners to reallocate and buy some of the portions that have declined a little bit further to get back to that. It's kind of like the way that pensions would think about doing it. I don't think 4% is inappropriate. Would I add it now? I might add it by potentially selling some downside puts to get a little bit of premium collection and hopefully pick it up at lower levels if we get a pullback. I will tell you that, like I said, everybody's looking up in it now. And Goldman comes out and they, announce these I'm not going to say far-fetched, but they ambitious price targets. Let's call it that. Wouldn't it be better just to say, you know what, I'm willing to add another 1%. So whatever I have, if it's 2% now, 50% of that allocation, I might sell downside puts on another 1% and look to collect some premium. Just do that systematically. Worst thing happens, it comes in. We get one of those really ugly commodity moves. What's that? Gap to new all-time highs, close lower, downside reversal, which I've always liked to say is one of the things that really concerns me. So that's something to think about. MM says, no portfolio margin offered at Schwab for retail, I don't believe. Huh. I don't know. I'm not a client of Schwab. So I can't speak to that. It surprises me somewhat, though. Schwab acquired TD. I don't have a TD account either. I mean, so obviously I would have a Schwab account now if I did. But that would surprise me if they don't offer CPM, but I guess it's possible. Personally, I wouldn't want to trade. Yeah, it doesn't sound right to me because TD had that. I mean, I'll put it to you this way. The TD portion of Schwab was, before it was TD, it was Thinkorswim. Thinkorswim was Sosnoff's operation, well, it's JJ, Tom, and all the rest of them. These are traders. I mean, they're not building platforms that don't sort of give people the tools, if you will. So I would find that hard to believe. I'm hearing from one of the producers that 125,000 and up is what I'm hearing from the producers if you check out their website. So you may want to look into that, but you have to have at least 125,000 there. Alex V says, wouldn't it be nice to have Tom Sosnoff as a guest here? Yeah, it would. I haven't reached out to him. I haven't spoken to him in a while, but perhaps I will do that. I think very highly of the guy, of course. He's the one that if people don't know, I believe Options Action, the show on CNBC, which was ultimately canceled after Schwab bought TD, but that was Tom's brainchild originally. He worked with a producer over at CNBC named Max Myers, and they came up with that show, and also I think Futures Now and a couple other programs sort of all fell out of that same thing. And there was another one briefly about currency trading called Money in Motion. It wasn't Tom's idea, but I'm just going to say that Options Action was basically where all of that originally came from. It was sort of his idea. You need to have a more product focused and trade idea, an idea generating program where you walk people through specific examples and what the process is. So yeah. So Michael Anthony, Mike, all the bankers were thinking that Pfizer was going to make a loss last year to make a profit in the first and raise earnings this year and dividend to 43 cents. Yeah, I don't, I'm not 100% sure what the consensus is now. Let's have a look. So the consensus right now for Pfizer, let's break this into quarters. What did you have for a number there? Let's just see this. You said they were going to make a loss last year to make a profit in the first quarter of a dime. So, well, the consensus right now is for substantially higher than a dime. So I'm not 100% sure where. Let's see. Well, let's take a look at it this way. I'm trying to figure out what banker you might be thinking of that would have such an outlook that is actually markedly below the current average consensus. And that's basically all of these folks put together. So it would have to be somebody who had a fairly negative outlook. I mean, it seems like there's a pretty wide spread. You've got BMO out here. They've got a $36 price target and an outperform rating. And then you've got Alexandria over at Wolf with a $25 target and Citi with a $23 target. So I'm not 100% sure where that dime number you have. Maybe you could just share that with us. I think probably everybody here who's looking at Pfizer would be interested to know where that dime estimate's coming from, because I doubt it's most of this. It's certainly not the average consensus for it. Let's start with that. Okay. Finwest says, Steve, contact Schwab. I just asked ChatGPT and portfolio margin is available with a whole list of eligibility requirements. Good luck. Yeah. And one other thing I want to just add about customer portfolio margin. If you don't use customer portfolio margin right now, first of all, I think, it's a valuable, I wouldn't have an account that doesn't have it. Start with that. The second thing, though, is I want you to think about the name customer portfolio margin and then make sure you're using it appropriately. Customer portfolio margin allows you to to use capital more efficiently, I would argue, than you can in a Reg T account. Great. So we have it up on the screen. Schwab.com/margin/portfolio-margin. You can get more details there. But independent of what they suggest there, I want you to think about this in terms of portfolio margin. Think about the way that I was just talking about how I might use it, how I have used it. And that is to trade constituent stocks against index and to trade options on each. It is not so that I can lever each stock by 4 or 5 to 1. It is so that I get a benefit of hedging a portfolio and buying the single stocks therein. So if you don't have customer portfolio margin and that sounds attractive to you, I urge you to think about using it the way it was intended, which was so that you get the benefit of hedges across your book, not so that you can somehow turn the leverage up to a higher number than you're currently employing and thus take more risk. The whole idea is so that you get the benefit of offsetting transactions that reduce your risk, and then you can deploy capital more effectively. And one of the other things I will also mention is that for several years, it was more appealing to do this at scale than it is now. Why is that? Interest rates are higher. So the higher interest rates are, the more expensive it is to borrow money. At one point, I'm trying to remember what the margin rates were at Interactive, which is where I hold an account that has CPM. It was a minimal number. Rates were close to zero. So were the margin rates. And actually, I know people that were deploying this at scale for other things. So, a lot of banks that have ultra high net services. So Morgan Stanley does this, UBS does this, probably every major bank does it. And I know people who did this. They have substantial assets. They have it at these banks. And the bank said, hey, you want to do something, just let us know. We'll write the check. And we'll take all of your assets into consideration and we'll allow you to borrow against those assets. Some of those assets will be liquid. Some of them will be illiquid. I mean, they literally are offering the people the ability to borrow at short-term rates against planes and artwork, real estate, stocks. I mean, the whole thing. And this hasn't gotten a lot of play. I'm imagining it's probably not a popular topic. I'm not going to mention the names of the people I know that are in this situation, but I can think of at least 2 who were offered the ability to borrow substantial amounts of money against their substantial assets, admittedly, and they, in some cases, deployed that leverage. Before the pandemic, some of these people went out and did things like say, I want income-producing property, and rather than selling bonds or taking out commercial mortgages, they just borrowed against their assets because they were able to borrow at effectively no interest. They're paying like 150 basis points over the risk-free overnight rate. So they're essentially borrowing money at less than 2%. Like, here's a commercial office complex. It looks pretty good. It's $25 million, and what's the carry on that? Interest only, because it's all just getting wrapped up into my assets. So, who cares? If I'm paying 2% interest, it's $500,000 a year on a $25 million office complex. Well, that works great until it doesn't work great. Because then you get into the pandemic, everybody goes home and they don't come back. And then suddenly the overnight rate isn't 50 basis points, it's 5%. So now you got a 6.5, you're paying 150 basis points over 5. That's 6.5% on 25. And you have no rental income. Like I said, I haven't heard a whole lot of play about this. This is not something I'm into myself, but I know people who are, and it's ugly. So if you're going to use the leverage tools and financing that your brokers can offer you, like customer portfolio margin, or if you're fortunate enough to be in the ultra high net thing, think about this. Use that power that they are giving you judiciously. That's all I can encourage. Tucker D. Dog says, sorry, didn't type full Netflix queue. All the strats you showed had the 17th expiration. They report the 17th, but after the close. Wait a minute. Is that true? Wait a minute. So, that's right. So this Friday is, thank you for reminding me, Tucker D. Dog. Totally slipped my mind. Friday is Good Friday. The market's closed. So normally, I've discussed this before, it is uncommon for companies to report Friday after the close. Thursday after the close is not so uncommon. Are they going to be reporting Thursday after the close such that... Yeah, so I am wondering, when are they actually... Hang on a second. We need to double check this. Yeah, this is a great point. You know, sometimes things... It's Monday. It didn't even occur to me. My kids had spring break last week. So the last thing that was occurring to me was that actually we don't have a trading day. That we're missing a trading day this week. But that's a biggie. That's a biggie. If that's true, did you identify a little bit of an ARB potentially? Holy smokes, that would be something, huh? You heard it here. You heard it here first, folks. You know, that's actually really interesting. So let me just go back to this. So Bloomberg definitely has it on the 17th still. And that's interesting. So we have, they are, holy smokes. Wow, this is something. This is really interesting. They said on March 14th, this is their press release. You can so you can go to ir.netflix.net, but you can Google this and you're going to come up with this yourself. So they said March 14th that they are going to be reporting at 1:01 p.m. Pacific time. That's after the close. So that is interesting. Okay. Now let's just double check something else. I would be kind of floored if options market makers somehow miss. We should have looked right at the first thing we should have done was look at the term structure, but it didn't even occur to me. Oh boy. Look at this. Oh wow. Okay. So this is a much more nuanced thing we're getting into here. Now, I am actually really curious. I would very much like to know. Alex V., I'm going back to you. Was this part of your thinking? That they weren't going to be trading on Friday and the options are therefore expiring Because let's think about this for a second, okay? If you get short the 985 calls, this could really be an interesting trade, actually. And this is why you really have to look at it from all... Son of a gun. So let's get that on screen. Alex V. Brilliant! There was a commercial. So this is really an interesting situation. So if we take a look at this, let's see what we notice. Okay, so stock's trading 930-ish. Okay, the straddle is 63 bucks. Call it. Okay, 63 over 930, so about 7%. So the question we have to ask ourselves now: the options market, they are, so they are still pricing in that the April. So the options market makers, they were paying attention. They got this, so you can see that the April 25th options have a good bid. Here's the interesting thing. You have, so everybody has to check with your own broker. Find out how to do this if you are in a trade. Okay? Because my question for you, Alex, is let's imagine that you are short that call spread. So you're short the 985s and you are long the 1025s. It's a $40 call spread. I don't have it up on my screen, but I remember which one it was. Now let's say that Netflix goes up 12.5% from where it is right now. That takes you to 1047, 1048-ish. Okay. So here's my question. There's a chance, a very good chance, frankly, that whoever owns those 985 calls doesn't realize if the stock closes at 940, let's say, on Thursday afternoon, those calls will not be automatically exercised, because to be automatically exercised, they have to be a penny in the money. You're short the 985s. There's a chance that the stock shoots up after hours. Now, any dealer who is long those calls, the 985s, so assuming they have some of the open interest, they will know what to do. They will file a contrary exercise notice, and they will exercise those calls. They will have until 5:30 Eastern time to do so. What will they be doing against it? They'll be selling stock after hours. And this was a common thing. I used to do this all the time as a market maker. If I had a lot of open interest on expiring options on a Friday, I would linger until, and just watch every stock we had. And, yes, correct. Options are exercisable until 5:30. The question is whether or not people will do that. So that's the question. So if you are short the 985s and you are long a higher strike option, there's we'll use an argument ad absurdum. Stock goes to, goes up 100 points or 150 points. Right, so it's at 1080. 1080 after the close on Thursday at 4:30. They report at 101. News is good. Stock starts ripping. First of all, if it's trading 1080, Alex V, are you prepared to then go and exercise those calls? Because you're going to want to, right? Because if it's 1080 and you're long the 1025s, those things are $55 in the money. So that's $5,500 per option. So you're definitely going to want to do that and then hit the bid in the stock at least after hours. But the thing you're not going to know, make sure your broker does what you want. So you obviously need to know what's going on. The second thing is that you have an unknown. are you going to be assigned on the 985s? We don't know completely. The average retail investor, the person who's not watching this live stream, who just happened to be in that spread and the stock went out at 940, 950 and figured, oh, my 985s are out of the money, so much for that, and does nothing. Well, if the stock trades above that, everybody who short that call wins a little bit, in theory, for everybody who doesn't exercise. Now, if a lot are in the dealer hands, like I said, dealers don't miss this stuff. If they do, they're out of business pretty quickly. You just play with margins that are too thin to screw around with this. So there's going to be a market maker. They're going to be watching the stock. If they are long any strike that's out of the money as of the close, but in the money post-close as a result of the earnings, they will exercise their options and probably sell stock in the after hours for the most part. But that leaves you in a very interesting situation because you will not know for sure whether you've been assigned on the 985s if the stock goes out below that price but trades above it after hours after they report on Thursday afternoon. So this is actually a really, that you brought this up is actually, this is one of those rare circumstances. And this is really quite rare. And the reason it's rare is because companies don't typically report after the close on Fridays. And that's when expiration normally is. The only reason that this is happening this way is because we have Good Friday. So Friday's close, expiration was pushed forward, and the company didn't adjust for that. So this is an interesting one. We're going to have another day to trade. I'm going to have to think about this. Maybe we'll get back to this on Wednesday for a little bit of a follow-up. James Forbin says, I knew April 18th markets closed. I just assumed you did too regarding Netflix. I do know that the market's closed on Good Friday. And the funny thing is, this Good Friday is very late in the year. And the reason I know, I am vaguely aware of when Good Friday is because that's when we usually celebrate our anniversary. It's easy to remember when we always have the day off. And we were actually married on April 6th. So I just recently celebrated our wedding anniversary. And we happened to celebrate it last Friday because it was also spring break. So the kids were off. And because this is so late, this is relatively late in the year for a Good Friday, it just was not in my mind today that, that's right. We've got Friday off. It's Good Friday. This is an interesting case. And it could be an opportunity to make some real money. I mean, I'm wondering whether Wednesday and Thursday would be some good times to sell some weekly options. You're going to see the premiums up there and maybe see, here's the tricky part. The tricky part is that you get to buy the implied. One way to think about it is this. You get to play a game that market makers usually play. They usually play this game ahead of ex-dividend dates because it's fairly common for some amount of the open interest that is held in retail hands of in-the-money call options on stocks that pay handsome dividends to not recognize that they should either sell that call before the stock goes ex-dividend or exercise it early, depending on whether or not the extrinsic value of the strike exceeds the net present value of the dividend that you're going to receive. This is the reason why you see so much in-the-money call option trading on strikes that have high open interest right before the stocks go ex-div. That's the dealers buying it back and forth with each other. You can be both up and down opening on a strike if you're a dealer, and then you exercise all the ones that you're long, and then you wait and see how many you got away with. And you basically get a free dividend every time a retail person forgets to exercise, to file that at the end of the day before it goes ex-div. But the amount of money that you milk out of that certainly it's not enough to overcome transaction costs. It doesn't really work for retail. And the reason is because the dealers are basically squeezing all the edge out. This is an interesting case because in a way, you're playing on the idea that... So, Anil, good question. Is it possible that Netflix could move the date? It's possible. Somebody could call investor relations and say, hey, you guys are about to... Could you announce at a different time? But at this point, it seems unlikely. Yeah, I mean, there's a lot of other... You could close out the short calls at 3:45 on Thursday. Well, here's the thing. I think being short those calls is kind of you're playing off the idea that somebody who owns them, maybe even most of the people that own them, either don't know or won't know or can't because they don't know how to exercise those call options and file that notice with their brokers. And that's a really interesting situation. Let's take a look. So a producer was just in my ear saying, will any broker automatically exercise? And the answer to that is no. Your broker is not going to exercise on behalf of clients without letting them know, an option that would not normally have been exercised. First of all, there's so many things that could go wrong by doing that, it would never happen. For one thing, there can be capital requirements. You could be long an option that costs $5 as of the close that goes out, out of the money. But to exercise it, let's say it's the 1,000 strike, right? So 1,000 strike call option times 100, it's $100,000 worth of stock. Maybe they don't have the capital to support the exercise. So there's a lot of reasons why that. And also, what happens if they see it's the 1,000 strike, it trades to 1050, they exercise the call, and then you wake up on Monday and the stock's trading $800. The person who owned that call option is going to say, it was not the OCC facilitation that has been worked out that they automatically exercise a penny in. Suddenly the broker is going to be left holding the bag saying, oh, well, we assumed you wanted to take... No, that'll never happen. They are far more likely to ignore an exercise request. This happened in things like Signature Bank and so on, than they are to automatically exercise options. So that's not going to happen. This is really an interesting situation. You kind of made my day with this, I have to say, because this is I kind of think I want to be short those things and play off. Let's take a look. I realize we're kind of really in there right now. We're well over an hour, so I'm going to cut this short really quickly. But before we do that, we're going to look at something together. We're going to take a look at the open interest on these upside strikes that expire on the 17th. Because all of that open interest represents options that may or may not be exercised if the stock finishes below that strike, but then is trading above that strike after earnings come out. Now, here, let's take a look at the thousands, right? Notice anything funny about the thousands? It's a round lot. 3,100 call options of open interest. Could have just happened to work out to 3,100. Might also be an institution traded those things as a block. Let's have a look. So that's not open interest. So we saw some big blocks in here. No, this sort of bled up. So that was not a single block print. So it just happened to be 3,100. Let's get back there. So if you're going to be short a strike and you don't want to get assigned in the event it blows through that strike, you have a far better chance if you are leaning on a strike with a lot of open interest. Let me explain. Let's just say for this, let's pick a strike that has no open interest, if there is one, which it doesn't appear to be. We'll say no to low. Let's go up a bit here. Let's find that a strike with the lowest possible open interest. And we're going to use this as an example. The 965s have 282. The 955s have 211. Okay. So if you sell, let's say you were going to trade a 10 lot. Okay. So you sell 10. Let's say everybody watching. Let's say there's 100 people end up watching this video and everybody sells 10. That's 1,000 contracts. When you guys go to sell your options, who are you selling them to? You are selling them to dealers. Okay? So those dealers, so we have 211 open interest right now. Assume nothing else changes. The open interest tomorrow is 1,211. And we know that 1,000 of the 1,211 are in the hands of dealers. Dealers aren't going to miss this. Okay? The dealers are going to exercise their options. Now, on the other hand, let's look instead at, say, the 980 calls. Okay? There's 2,600 of pre-existing open interest. So what that means is, let's assume that the 211 on the 955s are all retail buyers. So that means that the dealer community, on balance, is short 211 contracts. If we, en masse, collectively, we sell 1,000 to the street, then the dealers are now net long 800. And they're going to know to exercise them all. What does that mean? There's an 80+% chance that you're going to be assigned on your short call. It's just simple math, because it's, now you might get away with all of them because the way assignment actually works, it kind of goes around house to house and can end up being somewhat random. So some people can get away with more and some can get away with less. But, you know, that's the math. Let's instead pick the one with, say, the 2,600, like these 980s. So the 980s have 2,600 open interest. Now, we don't know. We can probably go back, and maybe if you're using unusual whales, it's worth the exercise. We can go back and try to figure out whether the bulk of that open interest was sold initiating or bought initiating. Now, if they were bought initiating, things get interesting. Why is that? Because if retail bought and dealers sold, dealers are short those contracts, retail is long. You cannot exercise an option you do not own. So the dealers won't assign you. It's up to retail to do that if we figure out that retail paper bought. So that's the strike you want to be short, because the chances that that one will be assigned are far, even though it should be, are lower than if you sell, if we all went out and sold to the street on a low open interest name. Monday morning quarterback. Wouldn't a simple way is to do a 417 buy rate? Well, that's right. If you want to be long the stock and you want to sell a call whose value might be overstated if you sold it into a higher strike, but here's the thing. You want to go back and try to figure out, was the bulk of that... Now, this is a much weightier problem, but we're very interested to know whether the dealer community, the market makers, are net long or short the strike. If you know they're net short the strike, that means that the open interest, think about it this way, the IQ of the open interest went down. And that's kind of unfair. I'm not really saying that people, the retail community isn't smart. What I'm saying is that they might not recognize what's happening, and they may not even know what to do about it, even if they do recognize what's happening. The dealer community won't be fooled. Right. As one of the producers mentioned, if you were in California, there could just be somebody sitting at work, right? Could be a West Coast employee who's sitting at his office desk, taking a look at what's going on. Like, I had a call option, and Netflix turned, and it didn't close above my strike. Oh well. And then they go home that night and they find out on the news or watching CNBC, oh, Netflix blew the doors off of earnings and traded to 10.25 after hours. And then thinking, oh my God, my 9.55s, those things would have been in the money. This is interesting. I think we all have some work to do. I've been chewing up a little bit. I've been taking it way too much of your time, 90 minutes so far. So I'm going to let you guys go. Like, subscribe, notification bell, and put thoughts into the comment section. We have to talk about this on Wednesday because there may actually be an opportunity here. And normally I say, yeah, we got to see if any other companies are reporting on Thursday. This could be an interesting week. And the other thing is normally I say, share the channel with your friends and all that kind of stuff. I can appreciate why you wouldn't want to right now, though, because usually when you find a really good idea, you kind of don't want to tell everybody. Which shows you how honest I'm being with all of you guys, because in the institutional world, I wouldn't have said anything once I figured this out to anybody. This is the kind of stuff you keep to yourself. So don't tell anybody. Let's do a little more work on this. And I will see you guys back here on Wednesday. Thanks for watching.